The Fed also works in what's called the repo market. Repo means repurchase agreement. So down the bottom, right? Repurchase agreement. So what do? I'm a bank. I have a problem. I need money. I need cash that I can get my hands on and do something with. How do I get that? Well, the bank has bonds. The government requires all banks to own a certain amount of bonds. Okay? And we talked about that before. The bank has to own these securities. It owns bonds, federal bonds. What they do is they sell those bonds to the Federal Reserve. So here I go. I sell, and there's, again, this can happen in the private market, but when times are bad, when the economy is, it's the Fed that's the buyer. So the bank sells the bonds to the Fed. The Fed gives cash to the bank. Now the bank has cash to go off and do whatever. Okay? Now I say go off and do whatever. Some of these things are overnight. Sometimes they just do this overnight, which is what you would think in the old days this Fed funds market was banks borrowing from each other overnight. But now they might do these repos overnight, or it might be 3 months or 6 months or a year. They're not forever. They're fairly short periods of time. Okay? At the end of this transaction, the bank buys its bonds back from the Fed with an interest rate. So the Fed charges interest on this. In these days, very low interest on this. But sometimes, because the demand for these have been really high, that interest rate has jumped up to 10% briefly, or even higher. And the Fed comes in and tries to calm the market down and push that interest rate back down. We can tell sometimes things are good or bad, right? And there's been times when, in fact, the Fed has offered to buy repos and nobody's wanted to do it. That's a sign that things are okay, right? But when there's a lot of insecurity, when people are worried, or when banks have to make some transactions and the cash there just isn't there for them to make those transactions, then they go play in this repo market. Okay? This is not something we taught people about 20 years ago, right? This is a new thing. It's not necessarily a new thing, but the size and the magnitude and the importance of this is growing. You're taking this class at a time when the whole nature of the financial system has been changing over the last 13, 14 years. And we have I'm not sure how it's going to end up, but it's probably going to end up being significantly different forever than what it was when it started. And that's why it's fun to be an econ major, particularly a macro econ major, because you get to spend time talking about all this new stuff that's happening. Okay, you'll hear people talk about the Fed's balance sheet. A balance sheet is a summation of the assets and liabilities of an entity. The Fed is basically a business. In fact, it's a highly profitable business most years. It gives the Treasury a bunch of money that it earns in profits. What does the Fed have on its balance sheet? Well, balance sheets, of course, are assets and liabilities. Okay, we should know that from last couple of videos ago. What's on the Fed's balance sheet? Well, most of its assets are these bonds. And most bonds it owns are these U.S. Treasuries. So it owns these government bonds, but it also owns a whole bunch, and by whole bunch I mean like trillions, of mortgage-backed securities. And mortgage-backed security, and again in a follow-on video we're going to talk about that more, but those are bonds that are backed by mortgages. Okay? And yeah, bonds that are backed by mortgages. And the Fed bought those up because if the mortgages are bad, the bonds are bad. And who's going to buy them? Well, the Fed. Okay? What are the liabilities of the Fed? Well, liability number one of the Fed is the Federal Reserve notes. It's the actual money that's out there in circulation. The second liability of the Fed is the deposits it takes. When banks have excess reserves, they can give those to the Fed and put those on deposit with the Fed. If we go back 15 years, those deposits of excess reserves are basically zero. And now we go look at those deposits of excess reserves, and it's a couple $1 trillion, and we'll look at that here in a second. So other thing that's changed, the other remarkable thing that's changed is the amount of excess reserves that the banks are holding on to. Okay? So when Janet Yellen, and we'll talk about her in a minute, when she was the first one to be chair of the Federal Reserve Board, appointed by Obama. When she was chair, the Fed was trying to shrink its balance sheet, to clean it up. It had all these mortgage-backed securities on it that, purists at least would say shouldn't be there, and there's a question about it. And the Fed's balance sheet was really big, and people were afraid of how big it was, and that all of this money in the system could end up causing inflation, right? We've talked about that. We'll talk about that more. And they were trying to shrink the balance sheet. That has all changed. So we didn't start paying interest on excess reserves until 2009. When a bank, if it's 2005 in the bank, or it's 1955 or 1935, and a bank has excess reserves and it gives them to the Fed to hold for them, they didn't get paid. It was like you're in my checking account, right? You don't get paid interest on your checking account. That was just the way it was. Well, starting in 2009, the Fed started paying interest on those excess reserves. And what happened when they did that is the amount of excess reserves in the system just exploded. Okay? Then the Fed has pulled that interest rate. They raised that interest rate for a while, and they pulled it back down. Raising and lowering that interest rate changes the way things work, right? If I raise that interest rate on excess reserves, banks are going to want to charge their borrowers higher interest rates, okay? We used to tell people in principles that, the Federal, if it wants to make consumers pay higher interest rates or businesses pay higher interest rates, it raises the discount rate and the Fed funds rate to do that. So let's think about this. If I'm a bank, the opportunity cost of me borrowing money is that interest rate I have to pay. And the lowest interest rate I have to pay, in the old days, the one I cared about, was this Fed funds rate. So if the Fed funds rate was 2%, I'm going to essentially, even if I don't have to borrow it, in my mind I have to think that I'm borrowing it. So I'm borrowing money at 2%. If I'm loaning it to you, I've got to charge 4 or 5 or 6. If the Fed funds rate is 8, I'm a bank, I'm borrowing money at 8%, I've got to charge you 11, 12 to make a profit. So the interest rates in the system that are charged to consumers and businesses are always higher than the discount rate and the Fed funds rate. But now it seems like the interest rate really matters is this interest rate on excess reserves. And if the Fed does what they did here on this graph in 2016 and 17 and 18 and 19, and they're making that interest rate go up, that makes interest rates for all the rest of us go up. Okay? Because if I'm a bank, I can put my money in the bank with no risk. I can give it to the Fed and they're going to pay me 2%. Well, I'm going to charge you 5 or 6 because you're risky and I need to make a profit. And I'm giving up this 2%. Okay? So banks, their interest rates are going to depend in large part on what this interest rate on excess reserves that the Fed is charging. When the economy, well, again, we'll talk about how the economy was doing, but they get a lot of political pressure to lower interest rates. How do they do it? It's not so much worrying about the discount rate or the Fed funds rate. It's worrying about lowering the interest rate on excess reserves, and that's what they did. Okay. We also now in the modern world use something called macroprudential policy. Macroprudential policy are policies designed to prevent trouble from happening in the first place. Okay? Changing the interest rates and all that kind of stuff, that's, you're sick and they give you some antibiotics and you try to do it, right? Macroprudential policy is like a vaccine in the financial system. It's supposed to prevent problems from happening. So the last two chairs of the Federal Reserve, Ben Bernanke and Janet Yellen, They are the ones that are largely responsible for the variety of macroprudential policies that are in place at the Fed. Some of them are old. The reserve requirements are a macroprudential policy, right? Having a reserve requirement means that banks always have to have money and they can take care of their deposits and they're relatively safe. Since Ben Bernanke, the types of different kinds of reserve requirements have changed, and some deposits, like deposits from hedge funds, and we'll talk about what hedge funds are, we still have to get there, but very risky types of deposits, the bank may have to keep 100% of the deposit. It may not be able to loan out any of it anymore. So the flexibility in reserve requirements, they don't change the 12%. That would be scary. But specialty kinds of things that are going on in the economy can have pretty significant different reserve requirements. Okay? Number two, what they call stress tests on banks. They take a bank and they take its financial situation and then they stick it in a computer and pretend that something bad is about to happen. And they see whether the bank can survive bad things happening to it. It's called a stress test. When you get older, someday when you're old, they're going to put you on a treadmill and they're going to make you run on the treadmill with all kinds of stuff attached all over your body, and they're going to check your heart, and it's called a stress test, and they're going to see if, depending on the results of the stress test, whether you're likely to have a heart attack in the near future or not. Okay? Same thing with the banking system now. Banks have to have these little stress tests, especially the big banks. They have to have these stress tests, and the banks often go onto the repo market and get extra cash right before the stress test happens because it helps them pass their stress test. Okay? It's a way to make sure that the bank's operations are not overly risky, at least in theory, a way to make sure that its operations are not overly risky and that it's not going to get in trouble if there's a financial problem. And number three, banks have to have extra capital requirements nowadays compared to what they used to. So it's not unusual for banks to be required to hold on to more bonds than they used to, or in other ways have resources inside the bank that they can use to cover in an emergency that they didn't have to before. So we set up this macroprudential policies as a way to try to protect the system from getting into trouble in the first place, right? They're the vaccines of the system. They're supposed to prevent us. But we all know the flu vaccine isn't exactly perfect, and obviously sometimes new bugs come along that we don't have a vaccine for. So things can still happen that aren't protected by this, but the idea is to try to protect the banking system better. Okay? Bernanke, Yellen, and Jay Powell had a discussion about this, and Jay Powell is much less a fan of macroprudential policy than these two are, and you should be watching some video here before long of them having that discussion. Too big to fail. What does economics tell us about how banks work? The idea of the financial system should be that there's all these banks all over the country, right? There used to be thousands and thousands and thousands and tens of thousands more banks than there are now. Right? We've talked about that. The number of banks is shrinking. What's happened is there's this small group of banks that are very large. So large, in fact, that we believe that the financial system wouldn't survive the crash of one of those banks. It would take the system down with it. That makes that bank too big to fail. And you can see on this chart over here the 5 biggest financial institutions: JP Morgan Chase, Bank of America, Citigroup, Wells Fargo, and Goldman Sachs. Okay? What do I do, though? Let's say I'm the president of Wells Fargo or Bank of America, and I know the government cannot let me crash because they believe if I crash, the whole system's crashing with me. Well, now I don't care, right? I can be mean to my customers. I can take risks. I can take some wild risks that a little country bank could never take, because that little country bank, if those risks fail, We're going to let them crash. We're going to let that little country bank go bankrupt. Okay? But Bank of America, we're not letting it go down. So these big banks, they're free, at least incentive-wise, right? They're free to do things that are bad for the system, that are good for them, but that are risky and might put them in a financial problem. Okay? This is why you got to think like an economist, right? Why is it bad to have these giant banks? Well, it's bad, if you want to use the word bad. It's bad because they're so big we can't let them fail. So we're going to bail them out. We're going to protect them. They're going to feel free to take these huge risks, and we're just going to suffer with that. Now, the Obama administration, again, wanted to do something about this and change the way the system looks at them, and basically the effort to do that kind of failed in Congress. But we have these banks that have 10%, each one of them has 10% plus, kind of when you put them all together, you're talking over 40% of all the banking activity in the country is these banks. Well, we're not going to let them crash, right? And that means, yeah, they don't have to pay that much attention or as much attention to some things as they should. And it might make the system less stable. All right. Who's in charge? Well, the answer is nobody. The Fed's in charge of some things, right? And the Fed was created in 1913, right? Treasury's in charge of some things. And there's Alexander Hamilton standing in front of the Treasury building. If you've ever been there, you should go. It's been around, obviously, since, the Constitution, basically. The Securities Exchange Commission, though, regulates the stock market. So the Fed is telling banks what to do, and the Treasury is telling banks what to do. The SEC is telling stockbrokers what to do. But can stockbrokers sometimes act like banks? Yes. Can banks sometimes act like stockbrokers? Yes. And you'll notice the Securities Exchange Commission was founded in 1934. So it's a product of the Great Depression. So the stock market prior to the middle of the Great Depression was not regulated as by a government entity. We have deposit insurance. If you put your money in a bank in an insured account and that bank goes bust, you get your money back. Up to $250,000, you get your money back from the federal government. When did that start? 1933. So that's part of the Great Depression. Okay? So the financial system before the mid-30s was largely unregulated. There wasn't a Securities Exchange Commission. There wasn't deposit insurance. Okay? Then there's some other government agencies. There's the NCUA, which is like the FDIC, except it's for credit unions. There's quasi-governmental entities that create money for mortgages. And they're called things like Fannie Mae and Ginnie Mae. They issue bonds that are basically backed by the government, and then they use that money to create cheap money for banks to make home loans, because we want to encourage home loans. Those guys got in serious financial trouble, and we'll talk about that again in our next video. There's also Sallie Mae, which is a government entity that generates scholarship money. That's not scholarship money, sorry, student loan money. When you go to the bank and you get a student loan, that money is coming in directly from this government entity, Sallie Mae, probably. Okay? So there's a whole long list. There's the Office of Thrift Supervision. There's agency upon agency, and nobody is really in charge of everything. Part of the financial crisis, they set up a committee, but we all know how valuable and useful committees tend to be. So all these guys talk together, but really there's nobody who's just in charge of the financial system, whose job it is to make sure that things are safe. Okay? So it all comes back to our favorite word, faith. Yes? The financial system works because we have faith in it. We believe in it. And as soon as we lose that faith, As soon as we're not willing to take that step when we can't see the staircase, then was when we get to be in big trouble.